bonds, that people should really be cognizant of the fact that, I'm not talking about the next several months, but on the other side of the bust, if we are, and I'm talking about inflation going from negative probably in the bust, I think we could see a bit of deflation in the bust. From there, by the end of the decade, we could be at 20% inflation rates or higher. Interest rates will track that, so we could be at a 15% long bond or higher by the end of the decade. That means bonds are going to be a losing proposition for most of the next cycle. Bonds have been a huge winner from 1981 until now. It's been a 40-year bull market in bonds. People need to understand that's coming to an end. I do expect one more move down during the bust to maybe even 0% 10-year. So it's not quite done yet. But on the other side of the bust, we are looking at a big bear market in bonds. And the only reason I highlight that, bring it up at the end here, is just investors should be aware that the game's going to be a major, we're going to be in a major game-changing environment where bonds are not a place where you can feel you're reducing your risk. It's going to be, because it captures so much more money than, represents so much more money than the stock market. It's also going to represent so much more loss of money when rates start moving up aggressively. So you're getting a little taste of it here with the rate move, but like I said, we're moving now from 135 to 2%. Wait till 10-year moves from close to zero up to 15% over the course of several years. That's when you find out how big the losses can be in your bond portfolio. So people should be aware of that. They should also be aware on the equity side that index fund investing has worked very well for the last 39 years, because you had that drop in interest rates over that 39-year period, that 40-year period. So you had the wind at your back in terms of, as rates move down, PE multiples, price earnings multiples move up. And so that helped the indexes. We're going to have the exact opposite in the cycle that follows the bust. As rates move up, price earnings ratios compress. And so as they compress across the board, in general, they put pressure on the indexes. So the indexes won't have the wind at their back. They'll have a very stiff headwind. And so index investing will not be nearly the successful approach that it's been for the last 39 years. In fact, active investors for the first time in a long time are going to find it fairly easy to outperform the indexes. So just kind of leave people with those two bigger picture thoughts.